Okay, so for the last 3 years, Chinese stocks have basically been in a deep freeze, right? But something's shifting. Global investors are starting to peek back in. The big question is this a massive opportunity or is it a trap? Let's dive in and really unpack the investment case for China.
I want you to picture a compressed spring, The harder you push it down, the more potential energy it's just storing up. Well, that's a pretty perfect metaphor for what's been happening in the Chinese market. It has been under some serious pressure, just compressed and waiting for something. And that brings us to the crucial question, doesn't it? Is this spring going to bounce back with even more force than before, or is it just going to snap under all that pressure? That is the billion-dollar, maybe even trillion-dollar dilemma for investors right now.
All right, so if we're going to understand the potential for a rebound, we've got to first understand what caused this compression in the first place. I mean, for 3 straight years, a whole series of powerful forces were just pushing the Chinese stock market down, down, down.
And look, what happened between 2021 and 2023, this wasn't just your normal run-of-the-mill market correction. A lot of analysts are actually calling it a full reset, a complete overhaul of investor expectations and how these companies are valued.
I mean, it was basically a perfect storm. It really started in 2021 with that massive regulatory crackdown on all the big tech giants. Then 2022 rolls around and you get the super strict growth-killing zero-COVID lockdowns. And if that wasn't enough, 2023 brought this deepening crisis in the property sector, plus all those simmering tensions with the US. Every single year just added another heavy layer of weight onto that spring.
So what was the result of all that pressure? Well, the MSCI China Index, that's a key benchmark for Chinese stocks, it absolutely plummeted. We're talking over 60% from its peak back in early 2021. That's a staggering decline, no matter how you look at it.
And just to put that into perspective for you, that drop wiped out something like $2 trillion in market value. The scale of that destruction was just immense. But here's the twist. As we're about to see, that very same reset might just be the launching pad for a major comeback. Okay, so after all that chaos, why on earth are some investors starting to get interested again? Well, the whole argument for a rebound really rests on a few key pillars. And the first one is one of the most classic metrics in all of investing: valuation. Just take a look at this. It shows a really stark contrast. You've got the forward price-to-earnings ratio for the MSCI China Index sitting at around 12 times. Now compare that to the S&P 500 over in the US, which is trading way up at about 22 times. That gap, that massive valuation gap, is basically shouting that Chinese stocks are, on a relative basis, a whole lot cheaper. All right, the second big argument here is diversification. Let's be honest, a lot of global portfolios are super heavily weighted towards US tech stocks right now. Investing in China gives you exposure to a totally different economic cycle, a different policy playbook. It's a way to spread out that risk and tap into a country that's still a powerhouse in global supply chains.
So where might future growth come from? Well, you've got to look at China's upcoming 15th five-year plan. They're shifting focus to what they're calling new quality productive forces. Now, what does that actually mean? In simple terms, it means the government is about to pour a ton of money into high-tech sectors like AI, semiconductors, and electric vehicles. The global tech race is definitely on.
Okay, so let's say the case sounds pretty compelling to you. How do you actually invest? For most of us outside of China, trying to pick individual Chinese stocks is, well, it's incredibly complex. So the most practical and, honestly, the most popular way to do it is through exchange-traded funds, ETFs.
And just a quick refresher for anyone who needs it, an ETF is basically just a basket of stocks. You can buy and sell it on an exchange just like you would a single stock, like Apple or Google, but it instantly gives you a piece of dozens, sometimes hundreds, of different companies all at once.
Now here's a really interesting angle. For investors in countries like India, where the local currency has been getting weaker against the US dollar, these US-listed China ETFs offer this unique kind of 2-for-1 benefit. Think about it. You get exposure to that potential rebound in Chinese stocks, and at the same time, you get exposure to the strength of the US dollar. It's like a double layer of diversification. So, the bottom line with ETFs is this. Instead of putting all your eggs in one basket, trying to bet on just one company, you get a diversified portfolio of the big players. Your Alibabas, your Tencents, your BYDs. This just massively lowers the risk of any single company blowing up on you. Plus, these funds are usually super easy to trade and very transparent.
All right, now we have to talk about the other side of the coin. It is absolutely vital to have a balanced view here. The potential rewards in China are huge, for sure, but they are matched by some equally significant risks, and it'll be totally irresponsible not to look at those head-on. These are the big picture headwinds. First, geopolitical tensions can just flare up out of nowhere and send markets into a tailspin. Second, that deep-seated property market slowdown is still a major anchor dragging on economic growth. And third, the lack of policy transparency is a real thing. It means the government can make sudden, unpredictable moves that are always a possibility.
And this right here is probably the single most important thing to understand when it comes to risk. An ETF is great, it can save you if one specific company implodes. But what it cannot do is protect you from these bigger, country-level macro risks. At the end of the day, you're still making a bet on China as a whole.
So that brings us right back to where we started, with our compressed spring. The Chinese market has been under this immense pressure for 3 long, hard years. All that potential energy for our massive bounce, it's definitely there. But so is the risk that the whole thing could just snap. So the real question for every single investor looking at this is, do you see all this pressure as an opportunity?